Welcome everyone to Monthly Update. Drew, as usual, welcome.
Good to be here.
What a month.
Exciting month.
Trump.
I'd be careful doing that around here too.
I know, he won, but anyway.
I've had some good feedback about the Badger on here, so we'll
Markets have done well though, haven't they?
It's been exceptional. Like even I think when we were putting returns out or putting quarterlies out in January this year, and probably in June as well, we keep saying these are kind of abnormally good returns and don't expect them to continue, and then they keep continuing. We're kind of doing the opposite of the future fund, where the future fund says how hard it's going to be all the time, and returns still come. We're saying, well,
be careful.
It'll get worse.
It's funny though, like as Australian investors, clients have always pushed back from investing offshore.
Yeah.
And over the last 4 or 5 years, offshore has really driven returns. And again, this year with the S&P and the Nasdaq, the two biggest kind of indices that you look at, up nearly 30%. I think 26 and 26 for the 12 months to date. That means the 1st of January to now.
And it's exceptional. And it's all come from basically two sectors, and you could probably say 2 or 3 companies.
Yeah.
But 26% for both the SP and Nasdaq to as we stand at the end of November.
Yeah.
Anything can happen at the end of the year, but you compare that to the ASX, and the ASX has only done 10%. Which also, the long-term average return from the share market only done 10%.
Still pretty good, yeah. And driven by banks. The banks have, everyone is underweight banks, don't want to hold banks. A million podcasters called out CBA at $100.
Yeah.
Well, I don't know.
We both called that out the opposite way.
Yeah. Because we're obviously amazing.
There is, I might put some stats in here. The Financial Review posted something this week that said which companies had contributed the most in index points to the ASX so far this year.
Yep.
CBA and Westpac had contributed something like 400 points to the index, which started the year at 8,100, and I think it's close to 9,000 at the moment.
Yeah.
But the vast majority of the increase in the ASX came from basically 2 companies.
Yeah, so this is the big quantum move to indexing, and we've had some debates internally, and essentially indexing is just a momentum strategy. Yeah. So you're essentially investing in the companies that are moving or growing the fastest, and you're putting more money towards the ones that have grown the fastest. And we've been in a momentum market post GFC, kind of 2011 to now. Everyone loves it. There's lots of risks attached to it, and we try to build portfolios around the index, but not just the index because of that reason. Driven by the one stock, which everyone talks about, and it has killed careers of fund managers, and it has made careers of fund managers, and that's Nvidia. Yeah. And once again, Nvidia has been able to grow their profits.
Exceptional. It was something like, I think their stock's up over 180, so nearly, tripled so far this year, just in 2024. Profit, and this is probably the scary thing, that all the headlines, and I think that was one of my, what grinds my gears, or get it off your chest last week, was the headlines. They said this could be the most important earnings report in history.
Yeah.
I mean,
I haven't heard that before.
Hyperbole. But Nvidia, so it grew revenue, so sales, and profit by 100% over the last 12 months, or quarter on quarter to last. So
it's done that for
doubled.
Like 5 years.
It just keeps doing it.
When it was just a graphics cards business, and then it was able to double profit.
Exactly.
And everyone didn't expect it. So quite amazing stock. Most people will be exposed to it through index funds, through active managers, and it's really driven the outcome.
And pretty much all their income now comes from data centers. So chips that are powering data centers all across the world. It used to be graphics processors and continue to evolve. I like this. Always look at profit margins of a business. Oh. They had a shrinking of their profit margin.
It's definitely not our business.
75% profit margin, and it fell to 73%, and that's why the stock basically went sideways when it reported.
I backtracked it the other day, and roughly it's 140, 150 depending on the day. Yeah. And if you bought it 10 years ago, 2014, it would have cost you 41 cents. Yeah. So 41 cents to $150. Yeah. So your advisor should have loaded up. So,
but again, it's one of those companies that, and there's a few in our portfolio that still do well, that seems like it's always expensive. Everyone always thinks it can't keep up this 100% growth.
Well, one of the problems is you can't do a traditional valuation of a company that can grow that quickly. Yeah. So typically what a stock analyst would do when they look at a stock is that they'll go 7-10 years, look at profits, margins, reasonable growth, how much capital does that take, do the present value of it, so what's the sum of all parts, and then come up with a number. Now, you can't do that when a company is growing, probably more than 20% per annum compound, because the compounding it that much means a much different result. When you're growing by 6 to 8 and you compound it out 7 years, it makes sense. But if you compound it by 20 or 30 or 100, who knows?
I reckon
where it ends up.
Yeah, and then I think there's a credit to Nick Griffin from Munro Partners here. So one of the funds in the model portfolio.
Yep.
Munro's done exceptionally well. He was an early kind of investor in things like Amazon and Apple, but also talked about Nvidia when it was everyone viewed it as a cyclical, so more like a mining stock than a growth stock.
So when he started his business, we were kind of first or second firm in to support him, and he was talking the story back then. So pretty amazing. Well done, Nick.
And that fund's up. His fund's up 33.
Yep.
Or 32% for the year. I mean, not quite the same as Nvidia, but it's outperformed the S&P and the...
Probably is true. I don't have my glasses.
The font's too small.
You do the finer stuff, I'll do the big words.
A little bit of a stitch up there. That's fantastic. And I think I'll go through a couple of themes that you can pick up from the top and bottom performers so far this year, but gold is probably the standout as well. I don't think there's a stock or an asset that is more questioned by advisors, investors, media at any point of any cycle.
Absolutely. We've had not just clients, but we've had advisors that have worked for us sell out gold in clients' portfolios because they couldn't explain it. So historically, I'd say gold was negatively correlated to markets, but the truth is it's uncorrelated to markets, right? So it just will behave totally different to what markets do, sometimes negatively, sometimes positively, and obviously it's been positive in the last 12 months. And in the last 12 months, which is interesting, if you look at the detractors from performance, it's probably going to be resources. And for the last 3 or 4 years, they've been incredibly hot as Australian investors. They're hunted for iron ore wherever they can find it, and then back into any material or mineral that is associated with the EV revolution. So that has come off quite substantially. So your BHPs, Rio Tintos, Woodsides would all be negative for the last 12 months. Yeah,
I mean, just looking through the portfolio, there's only like 10 of probably 42 investments that are negative for the year, and only I think 5 of those are more than 5% negative. And that's probably a story about the way we build portfolios. It's all about quality.
So tell us what's the worst.
The worst, and that's a pretty big theme, anyone reading the papers at the moment, is Ramsay Healthcare.
Yeah.
So there's a big challenge occurring in private hospitals.
Yep.
The credits or the payments from insurers and governments are under pressure, and their costs are going up naturally.
They expanded into France as well.
Yeah, exactly. Yeah, had an offer to sell part of their French assets. It didn't get off the ground. Couldn't quite get through due diligence, and the company's struggled. It feels like something's going to give. We've held this because of the ageing demographic theme in Australia and around the world. And the fact that waiting lists at public hospitals for surgeries are still incredibly long. So private hospitals are needed in some way. There's
always a question mark about, do you hold it, do you sell it? Our mentor, Ian Murdoch, I remember he came back from a conference in South Africa, and he gave me a little sheet, and it said pat the dog, and it's kind of one of our values too, right? So sometimes investments, you just have to pat them, make them happy, leave them there for a bit, and that's essentially what we're doing with that.
Yeah, the key is it's still a material weighting. It's not so low that if it recovers, it's not going to impact on your returns. So it's still material in our model, and in I think most clients' portfolios as well. And
a very kind of growth-orientated model. It's good to have value stocks, right?
And I think it was interesting that resources did poorly before Trump won the election as well. That it does feel like the Chinese are kind of managing a slowdown in the economy. Historically, we just saw booms and busts. We'll let the cycle run, and the bust got worse. Unemployment went higher.
China's economy has been okay though, but
it's still growing 4.5%. One of the fastest in the world. But the incremental growth and the incremental demand, particularly for iron ore, is tracking a fair bit lower, and that's why resources have been the worst performing part of the portfolio as well.
And when you say Trump, you're talking about potential tariffs coming on to Chinese steel that is full of Australian iron ore.
Yeah, Trump's, I think I've said the word patriotism before, but it's very I think the way people view patriotism is very different and very broad, and what Trump's doing is more protectionism.
I don't know what it is.
Protecting US companies, so he's going to support US companies. There's a few interesting things he's announced as well, and punish or put pressure on other countries as well. And it's actually not, if you look around the world, the European Union, Australia, Asia, China, every country has some sort of subsidies for different sectors.
Yeah.
Agriculture in Australia would be one of them as well. So,
I mean, there'll be people
more
will get
impactful
hurt from it, and that's what happens when Trump's in. Essentially, sends a lot
There's
more
winners
money
and
into
losers.
foreign aid and people in general, but for the US economy, perfectly. Tell me about Elon Musk, and is he going to be the next president? Because I saw a number where he supported the campaign he put $117 million into the campaign.
He's running a petition for people to win $1 million by signing up to vote for Trump.
Oh, really?
Like that. Yeah.
I didn't see that. So $117 million, and then the week after Trump got elected, Tesla stock, his personal Tesla stock went up $7.5 billion.
Yeah.
So it's not a bad investment.
Yeah, $117
for $7.5 billion. So
it wouldn't surprise me. I'm assuming he's a full US citizen because I think he was born in South Africa. I'm not sure about the specifics on that, but I mean,
you have to be born in the US
to be president.
Yeah.
Oh, I'm sure Trump can probably change it.
Yeah, Trump can change it. That's right.
And it's just, but it does seem this trend, and as much like there's always a lot of talk in Australia, and it doesn't always turn out well. But having people with more business experience in these roles, but I don't necessarily.
It's
agree
just
with
hope, isn't it? It's just the whole point. It's optimism and hope, and that's probably what people.
And the old get the government out of my life as much as possible, even if it's not what actually happens. What works.
But generally, we think the Trump government is expansionary for the US economy, and we covered a few issues before with the policies that potential come in, but corporate tax rates dropping, more protection, more capital for US businesses. Looks like it'll be expansionary, which you think the S&P 500 will benefit from over the next kind of 2 to 3 years.
And even some expanding of that rally as well. So something, the areas that are done poorly, energy, materials and these sort of sectors. And we know that, and even smaller companies haven't performed as well. So companies that aren't, Nvidia and Tesla. This more growth-oriented focus should help those smaller businesses, the broader parts of the economy. That saying, and less inflate. Like there's a risk that this is inflationary as well, and that interest rates have to stay high for longer.
Potentially,
but we've already seen small companies rally pretty strongly in the last 3 weeks alone.
Yeah, it's in crypto rally too, right? Yeah. So that's the kind of acceptance of the new, which probably through Elon is trying to accept the new. What does it look like? What does AI look like? What does currency look like? And I think Bitcoin's over $100,000 after being US. It's
like 160,000.
Being down like 12, was it?
Yeah, it went incredibly low. I thought it was interesting. If this is true, apparently Elon's got a role, not a government role, but a role advising the Department of Government Efficiency. Okay. So he's supposed to be cutting fat out of different government departments.
Got it,
and DOGE is the acronym of a cryptocurrency that Elon Dogecoin that he supported like 3 or 4 years ago. So that was, I don't know whether this is like reading the zeitgeist of the market or
Simpsons.
It's pro-crypto. Yeah, it's just some things you don't believe, but clearly there's something behind that as well.
Absolutely.
It wouldn't surprise you. I mean, Trump's always big in the media, so finding these kind of talk
and a larrikin too. So
yeah, exactly.
You could see them both laughing at it.
And that probably triggered, we've just finished our quarterly review period, so we were making some changes before Trump came in, and a lot of that was about diversification. So there's this idea of our portfolios have been very focused around the growth parts of the market, so companies that are growing quickly like Nvidia, like Tesla, like Amazon, like Microsoft, but much broader than that. And it was more a switch into value investing.
Sure.
Diversification.
Which has always kind of been our mantle, is to buy things cheap. Yeah. So look for companies that are trading, on a low PE, look for companies that are trading below their net tangible assets, look for fund managers that have got something unique to offer, that are charging a fair and reasonable price and are probably being rewarded on real performance, not absolute real performance. That would probably continue over the next 12 to 18 months as, we do have our tentacles into the growth elements of the global market, but we're also being conservative. Obviously, rebalancing is incredibly important. We've talked about that before. Make sure we're rebalancing to strategic allocations. Essentially what you're doing is selling high, buying low. It's pretty simple, but it's hard. Hard to take half year Nvidia, and for the clients that we have bought Nvidia for, we've probably sold it 5 times through the journey and halved it and halved it and halved it and halved it. Yes. which is a nice prudent way to build your total wealth. In the press in the last 12 weeks, the last 4 weeks, there's been a bit more about industry funds. Now, we don't normally comment about the industry funds.
No, we try not to.
But, there's been a few things. I think over the next 12 months will be a lot more as the size of these industry funds and the low cost of these industry funds are starting to squeeze the real performance that you're getting out of them, not just from a investment performance, but also from other associated benefits that you have. And you saw Cbus taking over the Coles by ASIC around not paying their death benefits out.
It might have been Host Plus, I think.
Host Plus.
Yeah. Or
Cbus.
Yeah.
Host Plus was a switching issue, I think. So, switching, pricing and switching.
Yeah, valuations. I think it's kind of this, they seem to be struggling with the burden of size because they're always the lowest cost. Like the big marketing point was lowest cost and strong performance. And now performance, things like Colonial First State is performing as well as industry super funds are.
Sure.
And fees are going up because you have so many members that you're trying to service.
Yeah.
And they're blaming third parties for a lot of these issues. But
this is what I don't understand, Drew. So nearly get it off your chest. Why do they still market? If you've got
3.5 million members at Australian Super.
Yeah, 3.5 million members, $350 billion.
And you're outsourcing administration.
Why would you?
And I think if you had to insource administration, your cost would increase significantly.
$39 million on advertising. Yeah. Why would you spend 39? And remember, Australian Super doesn't have a balance sheet, right? It doesn't have their own money.
Profit for members, yeah.
It's all the members' money.
Yeah.
So that's $39 million that came out of members' accounts to advertise to get new members.
It is the big question. How much size do you how much bigger do you need to get? And all these, it's basically consolidated into 10 main funds. Australian Super now is $340 billion. Is there still benefit of advertising for new members? It needs to be more about.
But is it a race? Are they all competing for each other? And essentially, once you tear the top off, there's not much underneath, right? They're all advised by the same asset consultants, if that's Jana or Frontier or Towers Watson or whoever it might be. So why do they advertise so aggressively?
Your super, they have to invest in a very similar way. They can't be too much different from the index.
Sure.
Like you're seeing a whole narrowing. I think whether is it the status quo, that it's just this continuation of growth and it's incentivized to have more and more members. The idea is that you have more members, you get lower cost, but it's been the opposite because they've got so many direct assets. It's actually got more expensive to manage.
I'd love to track the cost structure of a superannuation fund over the last 15 years. I'm pretty sure 15 years ago they were saying they were 70 or 80 basis points, and they're probably still 70 or 80 basis points now.
Yeah.
So, and they're 10
just
times
seemed cheaper. Yeah.
Sorry?
They just seemed cheaper.
Yeah.
There has to be concerns there. Like this idea that in the pandemic, and we spoke about this on a video at the time, which was if you're in an option that had a large portion of direct property or unlisted assets, they couldn't be valued regularly, but you're allowed to redeem that before that valuation went down and buy these other units over here with less of that property in there.
Yeah.
So reduce your risk, get the high valuation, and the people that were getting super guarantee contributions were forced to buy those units at the higher valuation, which wasn't true.
Yeah.
And it was this idea of
we'll actively recommend
daily liquidity. Right? Yeah.
We'll actively, an advisor.
This is going to fall.
Even if you have an industry fund doesn't mean you can't have an advisor. And the ones that we have, industry funds, which is, in terms of all the options a client has, industry funds should be considered in those options, then you still need advice around what to do. Do you buy asset class specific? Do you go into balanced? How do you take your pension? What does it look like? When do you sell? How do you be more conservative? There's a lot of advice that is, not really being provided on people with large balances within industry funds.
And this is why we see so many people leaving industry funds, and this is a trend they're seeing, and maybe this is why they're marketing as well.
Sure.
That when people hit retirement, I find that people want to know where their money's being invested. They want to know what's impacting their money, and they want to be able to be engaged with it. Whereas the industry super funds are incredibly difficult. There's really no way to call them. You're usually on an app looking at what the portfolio's done. And when times get stressful, you're trying to work out whether you've got enough money to generate the income that you had before from this pool of superannuation assets. There aren't many resources.
You'll be on a call centre for like 5 hours.
Yeah.
Where,
I tried during the pandemic.
Saturday morning on it, any given great Saturday morning, by 10 o'clock I've probably got 5 texts from clients just asking little questions or little concerns, right?
Yeah.
And they're not big concerns or they're not big questions, but they're resolved. Hopefully I resolve them pretty quickly, right? You're not going to get that from an industry fund, and you're probably not going to get that from an industry fund's financial planners that say, we just work 9 to 5, that's it.
Yeah.
So, okay.
So we've rolled in, get off your chest to end our monthly update. It's not like it's sufficient.
All right, I think we could leave it there. Is there anything else you want to mention in this? We'll do one more before the end of the year.
Yep. I was going to say, if we don't do one more, Merry Christmas.
No, you can't do that.
Okay.
We're going to do one more.
Excellent.
We'll send it out as a Christmas. Maybe we'll do Christmas and do our forecast for what next year looks like and what we're recommending.
Excellent.
All right. Thanks, Drew. Thanks, guys. Thanks for listening.